Right. So today we will be continuing with this calculation. Now, if you all remember, we calculated last time prices using this formula, and we calculated the current prices based on our theory. Theory was actually uh, the uh, uh, the value of a bond is equal to the present value of the future cash flows generated by that particular bond, and we have to discount it using required rate of return of the investors. So based on that principle, we calculated the prices of normal bonds. That means the bonds that are basically paying say, annual rates, and then we calculated them for semi-annual bonds. Then we calculated the price for zero coupon bonds, and then we calculated the price for perpetual bonds. And today, now, since we have calculated all these uh, uh, calculated the prices for all these bonds, now today what we are going to do is understand what are the factors that affecting this bond price. Now if you look at this formula, general formula, right? If you look at this formula, now this is the general formula for calculation of the uh, bond price, this formula. Can you all see this? Can you all see this?
Yes.
Right. Then, so based on this formula, we calculated the price. So now, if you look at this, as I mentioned earlier, now if you look at this C1, C2 up to Cn and M, those things are given. Even N, those things are given and well known at the moment of investment, because when you are going to invest in a bond, you exactly know what is the interest rate, what is the maturity period of that bond, and what is the coupon rate, and how the coupon is paid, whether it is semi-annual or annual, and what is the maturity value, in the sense that means actually the face value. So that is those information is already available. But what is not available is this R. So that R should be, it is a calculation, or it is assessment of the risk, and it is assessment of the particular investor. So based on the assessment of the risk, investors will decide their required rate of return, and that required rate of return will change according to several factors, based on several risk factors, based on the economy's situation. So if you look at this formula, the only thing that has an effect on this price other than this coupon rate and the maturity, those things are fixed and given. So what would be interesting to discuss is actually what happened to the price if this interest rate or the required rate of return gets changed get changed. When the in required rate of return is changing, what will be happening to the price of the bond? So that is what we are going to discuss right now. So let me move into the next sheet, so where we discuss these things. Now please, I hope that you remember the formula that we discussed last time. Now here, if you remember, we calculated this uh, values. So I am going to go uh, for the calculation for series of bond prices using that Excel function that we used in the last lecture. So here we calculated, and here we calculated this changes. So what I am going to do is uh, I am going to take the same example here. I'm going to take the same example here. The interest rate required rate of return on the bond price will change as the time pass. So that's based on the economic conditions. So now what I am going to do is calculate the same example. I am going to consider the same example and I am going to change the required rate of return. Now, in the previous example, if you remember, we used required rate of return as 8% in the previous example, 8%. So this was the required rate of return. So based on 8%, shall we calculate the bond price here again? So just to give you a refresh of the last time session. So what I'm going to do is I'm going to use the same formula. I'm going to use the same formula, and this is the formula here. So we know that required rate of return is 8% and bonds coupon rate is 9% and it is a 10-year bond, and par value we know it is 1,000 rupees. So all we have to do is actually find out this these values from the table. Now I am going to go for present value, interest factor, annuity, and here so I am going to find out the value corresponding to the 8% 10 years, 8% 10 years. So we have this value 6.7101. I am going to copy it down here. 6.7101, and I am going into the next table, that is present value factor table. 8% 10-year value, it is 0.4632, 0.4632, and I copied it down here. Now I'm going to apply these values into the formula, right? So let me go to this cell, and in the formula, the first one is first part you have C multiplied by present value, interest factor, annuity. So C is basically equal to what? C is 1,000 into 9%. 1,000 into 9%, that means 90 rupees. So 90 rupees multiplied by present value, interest factor value, present value, interest factor, annuity value, it is 6.7101, 6.7101. That is the first part. And the second part, M is equal to 1,000 rupees multiplied by present value interest factor, that is 0.4632. So you will have the answer, the same answer we calculated in the last session. It is 1,067. Now what I am going to do is I am going to increase this required rate of return from 8% to 9% and 10%. In the first scenario, I am going to increase this interest rate into 9, and in the second calculation, I am going to increase this to 10 to see what happens when this interest rate or the required rate of return is increased. So we'll straight away move into the first scenario, that is when the interest rate is equal to 9%. So only thing that is going to change is this present value, interest factor, annuity value, and present value, interest factor value. So how we are going to find it out? Again, I am going into the table. So I am going to now 9% 10-year instead of 8% 10-year earlier. So I'm going into the present value, interest factor, annuity table. So under 9%, I am going into the 10th year. So it is 6.4177, 6.4177. So I'm going to copy it down here, 6.4177. Then present value interest factor value, 9% 10 years, it is 0.4224. So 0.4224. Right. Now I copied it down. Then again I am going to use the same old formula. So here we have two parts equal. We have 90 multiplied by 6.4177 that is for this present value interest factor annuity plus 1000 multiplied by 0.4224 and close the bracket, enter. So you get this answer. You get this answer, right? So we have 999.99. That means approximately 1000 rupees. So that's how it comes. So let me round it up, so you will get a clear answer now. So if you round it up, it will come like this, right? So we have 1067 when the required rate of return is equal to 8, and we have 1000 when the required rate of return is equal to 9. So moving in, then I am going to increase the required rate of return further. So I am going to assume 10% here. So when the required rate of return is 10%, again I am going to calculate this present value of this bond. So again I am moving into the table. So present value interest factor. Now I am looking at the 10% column. 10%, 10 years. So I have this value 6.1446. 6.1446. I am going to copy it down here. 6.1446, and present value interest factor 10%, 10 years, 0.3855. 0.3855. Right, now I have extracted the value from the tables. Now again I am going to apply that into the formula. 90 multiplied by 6.1446 plus 1000 multiplied by 0.3855. Right, so you get this answer, 938 rupees. Let me round it out. Right, 939. So these are the answers we got. Right, these are the answers we got. For when the required rate of return is 8%, the price was 1067. When the required rate of return is 9%, the price was exactly 1000 rupees. When the required rate of return is 10%, the price was 939 rupees. Right. So with that, I actually want you to understand some of the Excel functions where we can use to calculate these present value interest. So in this, what I am going to do is I am going to introduce you two Excel functions where you can use to calculate these bond values using Excel. Right. So this is the first way of doing is actually using this price formula or maybe price function, and the second way of doing is actually using PV function. So I will show you how to do it using price function. Right. So the first, to do the price function, actually we need these information. Now if you go here and get that function from the Excel, so equal price. So you get this, you can see the variables that we need. We need a settlement date, we need a maturity date, we need a rate, we need the yield, we need the redemption, and we need the frequency. So based on the previous bond, let me calculate the bond price using this price function of the Excel. So first we need to find out these variables. So face value, as now we know the face value of our example is 1000 rupees, and coupon rate obviously we know it was 9%. Payment frequency, actually we know it is 1 because one coupon per 1 year. It is only 1 year coupon bond, yearly coupon bond. It is not a semi-annual. If it is semi-annual, you have to put 2 as the payment frequency. And required rate of return, in the previous sum it was 8%. And maturity period, it was 10 years. Now this settlement date and maturity date is actually, we will have to give Excel a date. Excel a date. Just imagine like now, if this particular bond is purchased today, so settlement date is actually purchase date. So we will have to add the today's day. So we can say today 26th 2020. So today is 26th July 2020. So since we have 10 years to mature, 10 years to mature, what we are going to add as maturity date is a date just after 10 years of the today's date. So again 7/26/2020 2030. So that is the maturity date. And the redemption is of course always, it is multiple of hundreds. It is multiple of hundreds. We will have to use 100 because that is a limitation of the it is not actually a limitation. Normally in US, most of the time the bonds are purchased in multiples of hundreds. That means $100, $200, $300, $400, likewise. So multiple of hundreds. So what we are going to do is we are going to add this redemption value as base value as 100. It is a function given with the Excel. So don't worry about that. I will show you how to calculate the value with this 100 value. So what I'm going to do is I'm going to now use this particular price formula. So what you have to do is equal price. So you get the formula. Now settlement date is the date that we purchase this particular bond. So I will select that settlement date. And then we have maturity period. So separated by a comma, I'm going to put a comma. Then we have maturity period. That means the maturity date. So I'm going to select that comma. Then the rate. Now rate is actually what we are receiving as the coupon rate. So we are going to select the coupon rate here, 9%. Then the yield is what we are expecting from the bond. That is the required rate of return. It is 8%. And then redemption is of course this 100 that is always given. I am going to select that 100, or you can just type 100 here. Then frequency of the payment, it is annual. That means it is 1. You can select here annual 1. And the basis, don't worry about the basis. Now there are several bases where we calculate based on the US type, European type. So what we are going to use is this US 30/360. That means 30 days for month and 360 days for years, right? 30 days for month, 360 days for years. So I'm going to select it. So close the bracket, then hit enter. So you get this value. So here the value you can see the price is coming like this 106.7. Now this price is calculated for a redemption value of 100 rupees, right? Redemption value of 100 rupees, but we have a redemption value of 1000 rupees. So what we can do is, how many hundreds for 1000? So we will have to multiply 100 by 10 to come into the 1000. So how you get this answer? 1000 divided by 100, then you have 10. So all you have to do is actually multiply this value, the price value, by 10, because for 1000 rupees we have 10 multiples of hundreds, right? 10 multiples of hundreds. So what we are going to do is we are going to multiply this value by 10 so that you get the final value of the bond based on this particular price function. Is it okay? All of you understand this? Anyone? Right, moving into the next function. There's a reason that I am showing this function, because you can use these things in the day-to-day life, and even I need this function to go ahead with this calculation, so we can calculate these things easier. So if I move into the next function that we are going to use, that is PV, present value. So for this function, if I bring the function PV equal PV, so you can, so we need some variables here also. We need the rate, we need the numbers means number of period, and we need the payment means how much we are going to receive in the each and every period, and we need the future value is actually the value that we are receiving at the end of the investment, that is actually equal to the face value. So what I am going to do is, first I am going to calculate this uh, coupon amount. How you calculate the coupon amount? So our redemption value or the face value is equal to 1,000 rupees, and our coupon rate is equal to 9%. So I am going to multiply 1,000 by 9%. So you get the coupon amount 90 rupees. Then I'm going to straight away apply this formula. PV is equal to, first we should give it the rate. We should give it the rate. So rate here is actually the required rate of return. Required rate of return. So I'm going to select 8% required rate of return, right? Then comma, then we have number of period. How many years? So for that I am going to select maturity period, that is 10 years. So then we need to add payment value. How much we are getting in each and every year, that is 90 rupees. I am going to select that, and then the future value, that is actually the face value of the particular formula for particular bond, particular bond. So I am going to select this 1,000, and the type is actually, we are going to assume that this all the coupon payments are going to receive at the end of the period. So I am going to select that 0, end of the period. End of the period in the sense, we are assuming that the bonds coupons are going to be received at the end of the year. So that is a normal assumption we get. So close bracket and enter. So you can see you get the same answer, but you are getting a negative value. So that is because of this particular function calculates the uh, present value. So when you are calculating present values, basically we get it as a negative value because we haven't given a initial cash flow here. So don't worry about that. So only thing you can do is you can add a negative value in front of this particular function, like this negative PV. So then you can have a positive value. Negative into negative, it gives you a positive value. So you get the same answer here also, 1,067. Here also using price function 1,067, and based on the formula also 1,067. So you get the same answer using whatever the method that you use, right? Okay, now going back to the things that we were discussing earlier, we were discussing about how the prices are going to behave when the required rate of return or the interest rate is changing, right? Right? How the prices are going to change. Now, if you look at this, when the required rate of return is 8%, when the required rate of return is 8%, the value of the bond was 1,067. When the required rate of return is 9%, the value of the bond was 1,000. When the required rate of return is 10%, the value of the bond was 939. Can anyone see any relationship between these two variables, required rate of return and price of the bond? Can someone explain me what is the relationship between these two by looking at these calculations? Anything interesting?
They have a negative correlation.
Yeah, of course. the relationship between price and the interest rate is actually inverse. They are moving in the different directions. Now if you look at this interest rate, basically they are increasing from 8 to 9, 9 to 10. But if you look at this price, the price is actually decreasing when the interest rate is increasing. So the conclusion here is there is a negative relationship between the required rate of return and the bond price. Required rate of return and the bond price. Actually, that is kind of obvious, because now if you look at this formula, the basic formula that we discussed here, this formula, if you look at this formula, now you can see the required rate of return R comes as the denominator of the formula. So when the denominator increases, it is obvious that the answer will decrease. It is kind of obvious. So now if you look at this relationship, I think you should be able to identify another interesting fact here. Can someone identify another interesting relationship here? Now, if you look at the second calculation we did, 9%. 9%, when the required rate of return is equal to 9%, the bond price is equal to 1000. What does that mean? Now, if you look at here, 9% is actually the required rate of return. But if you go for the original sum, you can see the coupon payment also equal to 9%. Coupon payment is also equal to 9%. Coupon payment is also equal to 9%. So when the coupon payment is exactly equal to the required rate of return, when the coupon payment is exactly equal to the required rate of return, the price of the bond gets equal to the par value or the future value or the redemption value or the face value of the bond, right? So that is the relationship here. Now if you look at clearly here, required rate of return is equal to 9 and coupon rate is equal to 9, and at that moment you are getting 1000 rupees as the price. That means when the required rate of return is equal to coupon rate, the price of the bond is going to be equal to the face value of the bond. So that is the relationship. That is another relationship that you can find out of this calculation. So let me calculate these values for a series of required rate of returns, and we can then show those values in a graph, like, so you can understand the relationship very well. So I'm going to calculate these things, the bond value of of a series of required rate of return. So what I have done here is I have just arbitrarily identify these R values, required rate of return values, going from 0 to 12. 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12. So these are just arbitrary value. And I am going to use the same example that we used. Face value is equal to 1000 rupees and coupon rate is equal to 90 rupees. Coupon value is equal to 90 rupees and maturity period is equal to 10 years. So what I'm going to do is I'm going to use the same old formula, that PV formula, for the sake of easiness. So I'm going to use that. So what I'm going to do is here PV is equal to, so we have first we have rate. Rate is actually representing the required rate of return. I'm going to select this 0. And then we have number of period, that is 10 years. 10 years. Then we have payment, that is 90 rupees per year. and then face value is 1000 rupees, and the type is at the end of the period. So this is what we are going to get. But since I am actually trying to drag this down formula, copy this down formula up to the cell number. Here we have cell number 75, C75. So what I am going to do is I am going to freeze all these variables. So 1000, it should be freezed. So I am going to here press the F4 button, and see coupon value should be freeze, and number of period 10 should be freeze. What is not freeze is actually required rate of return. So I am actually letting that to change when I am copying the formula down, and I am going to introduce another negative value here, because uh, these things are getting in positive negative value. So I am going to convert into positive value. So enter. So I am getting this. Right. So I got 1900 as the bond price when the required rate of return is equal to 0. So what I'm going to do is I'm going to drag this down. I'm going to drag this down, and you will get the answers for this bond prices calculated by the Excel. You can always verify these answers. Now we have already calculated some values here based on our trusty old formula. So based on trusty old formula, for 8% we got 1067. For 9% we got 1000, and for 10% we got 939. So we can verify that. So just go to the 8% we got 1067. For 9% we have again we got 1000. 10% again 939. So this formula is, that means this formula is okay and correct. So now you can see, you can easily see now when the required rate of return is increasing, when the required rate of return is increasing, the price is decreasing. So we have we have a negative relationship between these two variables, price and the required rate of return. Negative relationship. Here also, when the required rate of return is equal to the coupon rate, that is 9%, your price is equal to the face value of the bond. So let me put these values in a graph, so you can easily understand what is going on. So I'm going to select this graph, and I'm going to put these values into this graph. So let me go for the right design. So select data. So I'm going to add. Now x-axis would be the required rate of return. X-axis would be the required rate of return, and y-axis would be the prices of the bond. Prices of the bond. Right. So you get this type of a curve. Using Excel, you can derive these curves easily. So you can now look at this particular curve. Now this is downward trending from your left hand side to a right hand side. It is downward trending, just like a demand curve. That means there is a negative relationship between these two variables, the price and the interest rate. Now here we have bond price representing the x-axis, right? Bond price representing the x-axis. We have so let me right here bond price representing the x-axis, y-axis, and the interest rate for the x-axis, right? So and let me introduce some of the interesting points here. Now if you again, if you look at the 9% value, 9% value here 9% value. Now when the required rate of return is equal to 9% and it is equal to coupon rate, the price of the bond is equal to face value of the bond. So this point, we call this point par. Now at this point, we normally believe that the bond is issuing or bond is trading at the par value. So this point is, we consider it as par. Okay, and then anything beyond par value, if the bond is trading beyond the face value of that bond, right? If the bond is trading beyond the face value of that bond, we call it premium. So let me put it like this. So something like this. So this particular portion of the chart from this point to this point, okay, this particular portion of the chart, we call it premium, right? Then here, this part, if something less than the par value, if the bond is trading at a rate less than the par value, we call the bond is trading at a discount. So this part we call discount, like this. So the exact position where the required rate of return is equal to whatever the coupon rate. So at that point, we call it as par value, and something goes beyond, we call it premium, and something, if the particular bond is trading at a value that is less than the face value of that particular bond, then it is called discount. So in layman's term, if the bond is trading well below 1,000 rupees, that is discounted. If the bond is trading beyond the 1,000 rupees, that means it is premium. So you can understand the phenomenon behind here. Now if you all just think about this, now required rate of return is what you expect as the investor, and the coupon rate is actually what you are receiving, actually the actual value what you are receiving. So if you compare this, now when the required rate of return is higher than the when the required rate of return is higher than the coupon rate, something here, now coupon rate is 9%, if the required rate of return is 10 or 11 or 12, that means you expect for example, get this point, 11%, when the required rate of is 11%, you expect 11%, but you are actually receiving only 9%. So you are expecting more than what you are receiving. So at that point, your price tend to go down beyond the face value of the bond. So at this point, probably you are selling the bond at 882 rupees, 882 rupees. But when your required rate, when your expected rate is exactly equal to the what is actually receiving, when your required rate of return is equal to 9, your coupon rate is equal to 9. That means you receive what you expect. You receive what you expect. So at that point, your face value is going to be exactly equal to the bond of the price of the bond. So if something, when it comes to the other side of that, if when you are expecting less than what you are actually receiving, when you are expecting less than what you are actually receiving, the price of the bond tend to increase. So this part of that. So when the price is increasing beyond the point of face value, that means here if it is 1000, that part we call it premium. And then if it is going down below the uh, face value, that is discount. So that is how you describe these three type of bonds. So if there is a bond that is traded in the market exactly equal to a price that is to the face value, that bond we call, that is a par bond, par value. The bond is traded at the par value. If it is more than 1000 rupees, that is a premium bond. If it is less than 1000 rupees, that is discounted according to this particular example. So we can say now there is a inverse relationship between these two variables. So that is it for the relationship between these two, bond prices and the required rate of returns. So now I have given you some kind of summary here. When the market interest rate or yield decreases, the price of all existing fixed rate coupon bond will rise. When the yield decreases, it there is an increasing tendency. So that is the inverse relationship, and the vice versa. And the most important part here is actually this fundamental principle of the bond investing, is that market interest rate and the bond prices generally move in opposite direction, and this phenomenon is normally called interest rate risk. This is actually identified as one of the main risk that is involving in a bond investment. So what is the risk here? Now, for example, we now think that the required rate of return is 9%, but in the future, due to some economic conditions, if the required rate of return tend to increase, if the required rate of return tend to increase, for example, here, now at the moment we are thinking that the required rate of return is 8%, right? Required rate of return is 8%. What if required rate of return is increase up to the 11%? What will happen is, when 8%, we can sell this bond at a price of 1067. But due to some economic problems, economic conditions, what if the required rate of return is increased up to the 11%? Then your price will be decreasing down to the 882 rupees. So that is the risk we are facing as a bond investor. So that particular risk, we call it as interest rate risk. We call it as interest rate risk. So what is the problem with joining here? Some students are waiting to join. So I have not opened any waiting room here. Anyone can join without a problem. Any responses from any student? Did you understand what I have been explained here? Should I explain it again, or right? Okay, now moving into the next step. Here we are going to discuss. Now in this point we discussed how the uh, price of the bond change when the required rate of return is changing, and then we are going to discuss uh, how the what is the effect of this interest rate when the maturity of the bond is changing. Now the interest rate risk is actually the relationship between bond price and the required rate of return, and we call it as there is a relationship, there is a negative relationship, and we proved it in the last discussion. So now here what we are going to understand is what will happen to this required this relationship or the interest rate risk when the maturity of the bond is increasing or decreasing, right? So normally we tend to say the required rate of return is the interest rate risk is higher when there is a higher maturity. The explanation for that is actually when there is a higher maturity period, the bond is exposed to the economic condition longer time, right? The bond is exposed to the economic condition for longer time. Because of that, there is a tendency of increasing or decreasing the interest rate in the economy. So that will have an adverse effect on the bond price. But if there is a short-term bond, that means a bond that has a less maturity compared to the uh, long term one, so the period that the bond is getting exposed to the market is very limited. So because of that, it has a less required rate of return. It has a less required rate of return. So that's how it's happening. Now bond maturity, uh, now the explanation here is higher the maturity, higher the required rate of return, lower the maturity, lower the required rate of return. So the uh, so we will try to understand this actually with another example, so you can uh, you would be able to understand this with this again using this uh, chart. So what I'm going to do is again what I'm going to do is I have introduced you a separate bond here. Now if you just please look at this example, you can see example. All right, example, suppose that you have two bonds with a face value of 1000 rupees and 10% coupon rate, but with a different interest rate and two maturities. But with a different interest rate and two maturities, right? So what I'm going to do is I'm going to identify these variables. Now future value is 1000 rupees. It is given in the example, and the coupon value is equal to 1000 multiply by 10% in the sense 10%. So your coupon value is exactly equal to the 100 rupees. So this is an annual coupon bond, and we have two maturities. What are the two maturities? We have 2-year bond, we have a 20-year bond. 2-year bond and a 20-year bond. Okay. Now what I'm going to do is I'm going to again use that PV function and calculate the values. Calculate the values. So for the 2-year bond, I'm going to again get this PV equal to rate is 2% here, rate is 2%, and then the number of years, that is 2 years, and then payment is equal to 100 rupees, and the future value is equal to 1000 rupees, and the type we know at the end of the period. So what I'm going to do is same as earlier, I'm going to fix these values, and end. So you get this value, so 1100 and 55,155 as the bond value when the required rate of return is 2%. Now, same way, I'm going to drag it down. So you get the answers here. You get the answers. So then I'm going to go for the next bond, that is a 20-year bond. Again, I'm going to apply the formula equal present value PV, and rate is again 2%. Now I am going to change the number of period, that is 20 years instead of 2, and the payment is 100, face value is 1000, and type is end of the year 0. Close the bracket. Again, I am going to fix these two values, this one and this one. Enter. So you get the value here, and I'm going to introduce a negative sign here. So you get 2,308 value. 1,308 rupees as the value of the bond when the required rate of return is 2. So again, I am going to drag this down like this. So Excel will give me the answers like this. So when the required rate of return is 26, 2-year bond, you have a value of 772. 20-year bond, you have 391. So let me put this value into the chart so you can understand the relationship properly. What I'm going to do is select the data. So I'm going to add the first one, 2-year bond. Add. Under the x-axis, I'm going to put these R values. Under the y-axis, I'm going to put prices. So you get this curve, right? You can see there's a downward trending curve. There's a negative relationship. And again, now I'm going to add a second line for the 20-year bond, right? For the 20-year bond. Let me edit this and add this value also. It is 2-year bond. So you will get that. And at the second value, the name is 20 years, and x-axis it is always required rate of return, and y-axis is equal to the prices. So you get this. So now you can clearly see the orange line actually represents the 20-year bond, the orange line, and blue line represents the 2-year bond. Now you can see the difference here. Now when the required rate of return is exactly equal to the coupon rate, you can see at the 10%. Now when the required rate of return is 10%, now if you look at, if you can see it here also, when it is 10%, when the required rate of return is equal to the coupon rate, now the coupon rate is also equal to 10% here. The both bonds, whatever the maturity they have, the price is equal to the face value, 1,000, whatever the maturity. Even though maturity is 2 years, even though maturity is 20 years, that is equal to 1,000. So that point is represented here in this graph, right? In this place. Now let me have in this place. Okay. Now the interesting point here, what will happen if the interest rate get increased? Now interest rate risk is actually the risk of increasing your risk of decreasing your price or increasing your price based on the changes that is happening to the interest rate. Now here we kind of let me assume that the interest rate increased from 10% to 20%.
අම්මා මේ පන්තියට ගිහිල්ලා. ඉතින් යාර කියලා ඒකෙම තියෙන්නේ. නේ කියන්නේ
right. There was a technical problem, sorry for that. And so now coming back to the graph, now you can see what my assumption is. I am going to increase the required rate of return from 10 to 20. Now you can see I have, when I am increasing this to 10 to 20, the if you look at the 20-year bond, the value of the bond decrease up to 500 rupees. Now earlier it was around 1000. Now at this point, when the value is 10%, now let me highlight this. Now here it is, the value is 10%, right? When the value is 10%, when the value is 10%, when the required rate of return is 10%, the value of the bond is 1000 rupees for both the bond. Now when the required rate of return is 20%, when the required rate of return is 20%, the value of the bond, the value of the bond for 2-year bond, it is 847. For the 20-year bond, it is 513 rupees. Now you can see the difference here. Now, if it is only a 2-year bond, it will only decrease fractionally from 1000 to 847. 1000 to 847. The difference here, if I want to calculate the difference here from 1000 minus 847, the difference, it's only 153. But if you look at the 20-year bond, let me calculate the difference there. 1000 minus this, so you get 484 value rupees as the difference. So that means when the bond, when there is a bond that has a higher maturity rate, higher maturity period, that particular bond has a higher interest rate risk, higher interest rate risk. So higher the maturity, higher the tendency to decrease the value, higher the tendency to decrease the value. Now you can see here, now for the same values, we have 2-year bond and 20-year bond. When the maturity is 2 years, it will only decrease by 153. But when the maturity is 20 years, it decreased by 487 rupees. 487 rupees. Right? So you can see now this point, at this point, coupon rate is equal to required rate of return at this point, and this particular axis is bond price and this one is interest rate. So anything that I should explain about this, is it clear? Now this particular graph, is it clear? Now it says that long-term bond have more interest rate risk than the short-term bonds. So this is how you prove that. This is how you prove that. Anything that I should explain again? Right. So with that, now we have learned that if there is a bond investment, we will have to face a required interest rate risk. We will have to face an interest rate risk. That phenomenon is actually uh, actually defined as the relationship between interest rate and the price of the bond. So here what we understand is actually when the maturity period of the bond is higher, there is a high tendency of having higher interest rate risk. So the one of the deciding factor of the interest rate risk is the maturity period. Higher the maturity period, higher the interest rate risk. Lower the maturity period, lower the interest rate risk. So that is what this particular graph represents. Now if you look at this orange graph, you can see the slope of the graph is higher compared to the blue graph. the orange line, if you look at the orange line, the slope of the orange line is higher compared to the blue line, right? Compared to the blue line. So higher the slope, higher the risk. Higher the slope, higher the risk. When you have a higher slope, that means you will get aggressive price decrease for a unit of increasement of the interest. When there is a 1 unit increasement of the interest rate, there is a aggressive price drop. If the slope is higher, that is what is representing here. Now we have a decrease from, we have increasement of interest rate from 10% to 20, 10% to 20, and price is dropped from 1000 to around 500 rupees, exactly for 530. So that is an aggressive drop of prices. Now if you compare that with the less maturity period bond, which is 2 years, now again here the interest rate is increased only from 10 to 20, the same increasement, but the value is only dropped from 1000 to 847. That is not actually an aggressive drop. So when compared to a 2-year bond, if you compare two maturity periods with the interest rate risk, that means when the maturity period is higher, you get to expose your bond for a more interest rate risk. That means there is a more possibility that your price is going to be fluctuated in the future if the bond has a higher maturity period. So that is what you want to understand here, right? So let me move into the next slide. And here in the next slide, we are going to understand what will happen to the bond price when the maturity period is higher. When the maturity period is higher. So one student is asking, please explain again, sir, if we buy bonds in the same amounts for both 2 years and 20 years, how will be the curve? So that's what I have explained here. So we are buying in the same amount. If you buy only a one bond, for example, by giving here by giving 1,000 rupees. For example, if the market price is 1,000 rupees, we are going to buy it on the 1,000 rupees. Now, if the required rate of return is 10 rupees, sorry, 10%, then the market price is 1,000. So if we are going to buy that 1,000 rupee bond, then if the required rate of return increase somehow in the future, in the coming years, this is what will happen. For example, if you buy it at 1,000 rupees now at the moment, if it is a 2-year bond, if in case in required rate of return increase up to 20 in the next year, the price of your bond will drop up to 530. If it is a 20-year bond. But if it is a 2-year bond, your price only dropped up to 847 rupees. So that is the difference here. The assumption here, for example, you are going to buy this bond at the moment for 1,000 rupees, that and thinking that the required rate of return is 10% based on the economic conditions. So required rate of return is 10%. Since the required rate of return is equal to the coupon payment, you can buy the bond a value exactly equal to the face value, that is 1,000 rupees. So when you are buying that bond, you don't know what will happen in the future. So due to some reasons, if the required rate of return increase up to the 20% in the next year, then you will have to your bond will the price of the bond will drop. If it is a 2-year bond, up to down to 847. If it is a 20-year bond, it will drop down to the 513 rupees. So that is what happened. So moving into the next one. Now here we are going to understand what will happen to the price when there are different maturity period. during the maturity period of the particular bond, during the maturity period of the particular bond. So what I'm going to do is I'm going to calculate these values based on this particular example. Please, can you just straight away look at the example and try to understand? Please read it out. Imagine that you have 1,000 rupee bond that pays only 9% coupon, the same example, annually, and maturity in 10 years. And calculate the bond values based on three required rate of returns: 12%, 9%, and 6%, assuming them to be remain constant over the 10 years period of the maturity bonds maturity. Now 9% is the is when the required rate of return is 9%, it is equal to the coupon payment. That means the price of the bond is going to be equal to the 1,000, right? Equal to 1,000. When it is 12, the price is going to be less than 1,000. When it is 6%, the price is going to be more than 1,000. So that is the relationship we know now. So let me introduce the same old formula so that you can calculate this value. So here, when the maturity is now, I have actually inversed the maturity value from 10 to 0, from 10 to 0. So let me calculate those things. When we have a maturity period up to 10 years, that means at the moment when you are buying the bond, you have 10 years. So let me give the formula, present value. So maturity period, the rate here, the rate is 6%. So I'm giving 0.06, and number of period, it is 10, and then we have payment, it is 90. I'm going to fix that value. And then we have future value, it is 1,000. Again, I'm going to fix that value also. Then at the end of the year. So that's it. So I'm going to close the bracket and add the negative value here and enter. So you get this as the answer for the bond price. The bond price is 1,220 rupees when there is 10 years, when there are 10 years to mature. So let me drag it down. Right. Now when there are 9 years to mature, the value of the bond is 1,204. When there are 5 years to mature, the value of the bond is 1,126. When there is only 1 year to mature, the price of the bond is 1,228 rupees. When there is no period to mature, that means exactly at the end of the period. Now that means at the end of the maturity period, after 10 years, the value of the bond is actually equal to the face value, because that is what you are getting at the end of the maturity period. So when you buy the bond, you had 10 years to go. When you are reaching your maturity period year by year, the value kind of decreasing up to 1,000 rupees, which is equal to the face value. So let me go to the next one. When it is 9%, so only thing that is going to be differ is actually required rate of return. PB rate is going to be 9% instead of 6. 9% instead of 6. That's all. So I'm going to hit enter. So you get 1,000 rupees as we expected. Now if you copy this down, you get 1,000 rupees for all the maturities, because we know that when the required rate of return is equal to the coupon payments, the price of the bond is exactly equal to the face value. So let me move into the next one, that is when it is 12%. So when it is 12%, only thing that is going to differ is actually this required rate of return. Instead of 9, I am going to put 12. So again, enter, then you get this answer, and I'm going to copy it down. And again, it will show a different way. Now, when the required rate of return is 6, it start a value that is higher than the higher than the face value, and when the time goes, at the end of the maturity, it will settle down at the face value. Now, if you look at this, when it is 12%, the the value starts a value less than the face value, that is 830. Face value is 1000, and it will increase up to the 1000 rupees, and at the year 0 it will settle at the 1000 rupees. So let me put this into a graph so that you can understand this easily. So I am going to put these values into a graph here. So right, I'm going to add the first one. When the R is equal to 6%, x-axis is representing what I'm going to do is now axis here, I'm going to change the axis for maturity period, just to give you a good understanding. So I'm going to give x-axis for maturity, right? Then y, I will give it to the price. So you get something like this. And I'm going to add another one, that is when it is equal to 9%, and x-axis is the maturity period, and y-axis is exactly equal to the prices. Now you can see it is always 1000 rupees. You will get a straight line like this, straight line. So then again, I'm going to add the next one, that is when it is equal to 12%, and x is always the maturity here, and y is the prices, right? Okay, now you can see very clearly in this particular graph. Now, when the required rate of return is lower than the coupon value. Now here the coupon value is 9%, required rate of return is 6%. That is the blue line. When the R is equal to 6%, it will start at the investment day, it will start at a value higher than the face value here. Now here the value is 1220, this value 1220, and it will, when you are approaching your maturity, it will kind of decreasing and settle it down at the maturity period, at the end of the maturity period, in 1000 rupee value. And when the required rate of return is higher than the when the required rate of return is higher than the coupon value, it will start at a value that is less than the face value, less than the 1000 rupee. Now here the value is 830. So it will start at 830, and kind of increasing way, it will increase up to the 1000 rupees when you are reaching your maturity period, when you are reaching your maturity. But if it is 1000, if it is exactly equal to the uh, coupon rate, when the required rate of return is exactly equal to the coupon rate, it will always a straight line like this. It will not change. It will not change. So this is what happened when the maturity period is reached by the investor. So if you are starting at a higher required rate of return than the coupon rate, that means in the future there is a tendency of decreasing your price. If you are going to start it at a lower required rate of return than the coupon rate, and there is a tendency of increasing of your price. So this is actually relevant to the decision that we are making. So we only actually recommend to buy something that is higher than the if we when we calculate our prices, we only recommend someone to buy. There is a market value that is lower than the calculated value. Now for example, if you are in this point, you are going to buy that bond when you have 10 years of maturity, and if your required rate of return is 6%, right? If your required rate of return is 6%, you have calculated this value 1220. Now if the market value is less than this, only you are going to buy it. Otherwise Otherwise, your investment will not be a good one. You may be you may be getting a loss. So that's why at the moment that we discussed about this intrinsic value, when we calculate it, we compare that with the market. We compare that with the market, and we calculated it with the uh, then we decided whether to buy it or not. Whether to buy it or not. Right. So this is what we calculate. Sorry for interruption. Uh, so based on the maturity period, this is how the prices are behaving. When you are approaching your maturity period, this is how your prices are behaving. Right. So anything else that I should clarify? Anything else? Right. So let me move into the next one. With this, then what we are going to do is we are going to calculate whatever the yields for bonds. Whatever the yields for bonds. Now, by understanding yields, you can identify how much you are getting as your returns typically per 1 year. That's what we are going to calculate. Normally, we can identify 4 types of yield for a bond. First one is nominal yield, and then the other one is current yield, and we have yield to maturity, and we have uh, yield to call. These both of these two, yield to maturity and yield to call, are similar things, because when we have a bond with the call option, probably a student can call the bond before the maturity. So if that happen, we can calculate the yield to call. Otherwise, then we can calculate the yield to maturity. So we will understand what is normal yield, current yield, and as well nominal yield, current yield, and yield to maturity, and yield to call. So first, I am going to discuss about yield, nominal yield. Actually, this is a very easy thing. We don't want to calculate anything. This is the simplest measure of the yield or the return of the bond. So how you identify this is actually it is actually printed in the face of the bond, or the communicated at the moment that you are buying the bond. That is actually the uh, given coupon value of the bond. If the coupon value of the bond is 9%, that is actually the nominal yield of the bond. That is actually the nominal yield of the bond. Now, if you look at the last example, it says that there is a bond for 10 years and the coupon rate is 9%. So that means nominal yield is equal to the coupon rate. Nominal yield is equal to the coupon rate. But we cannot compare bonds based on that nominal yield. As you know, when the required rate of return change, the price of the bond gets to change. when the interest rate changing, the nominal yield, the real value of the nominal yield actually tend to change. So when you are comparing bond, it is not advisable to compare bond based on your nominal yield. It is just the nominal yield. So, and the current yield is actually it is a different concept. Current yield give you the return of the particular year you are looking at the moment. For example, if you are if the at this moment, if you are in the fifth year, what is the return of the fifth year? Something like that. Now it is a very easy calculation. All you have to do is you can calculate the current yield by dividing your coupon payment by the current market price. Current market price. It is not the price that we are calculating. Please keep that in mind. This is the current market price. The price that we are getting straight away from the market. It is not the value that we calculate. Right? So what we are going to do is we are going to divide the coupon rate of the particular year by the current market price. If you look at this example, you can clearly understand this. Now, this example says that you have you have 1,000 rupee par value bond with a 10% coupon interest rate, and the currently sells at 900 rupees. What is the level of current yield? What is the level of current yield? So now, what is the level of current yield? Now, all you have to do is calculate the current yield. What you have to do is identify this coupon value per year. Now, coupon, how you calculate the coupon value? You can calculate the coupon value by multiplying 1,000 rupees with the coupon rate 0.110%. So then you get the coupon value. Then what you have to do is you have to divide it by the current market price. You will have to divide it by the current market price. Current market price. It is very easy. Current market price is given. It is 900 rupees. So I'm going to divide this by 900 rupees. So you get this as your so-called current yield. So let me put into the percentage value. So you get 11.1111% as your current yield. Now here nominal yield of this particular bond is equal to 10%. Nominal yield, because it is given 10% coupon interest rate, but the current yield is 11.11%. That is the yield that you are getting at the moment based on the current market price. Okay, so that is the difference between current yield and the nominal yield. Nominal yield is what is given. What is given? That is 10% here. But when you calculate the current yield, you can see it is 11.1111. The difference here is actually we are not calculating the current yield based on the face value. We are calculating the current yield based on the market value. For example, if we calculate the current yield based on the face value, so instead of 900, you can put 1,000 here because it is the base value. Then again, your current yield would be exactly equal to the nominal yield here. But since the market value is less than 900, less than 1,000 rupees, it is 900. You can see you get a yield. You get a yield than what is given in the as the nominal rate 10%, 11.11. Right. That is what I have mentioned here. This will always be equal to the nominal yield if the current market price is equal to the par value. When the current yield will be greater than the nominal yield when the bond is selling at a below par. When the current yield will be lower than the nominal rate if the bond is selling at above par. That means if the bond is above par, in the sense if it is a premium bond, then you get a lower yield. You lower current yield than the nominal yield. If it is a discount bond, you get a higher current yield than the nominal yield. So that is how you differentiate between nominal yield and the current yield. And moving into the yield to maturity again, the third yield concept, yield to maturity. Now you can see, if you read out this particular statement, it says that the yield to maturity or the redemption yield of the bond is actually the internal rate of return. I think you are familiar with this IRR, internal rate of return of interest, earned by the investors who buys the bond today at the market price, and assuming that the bond will be held until maturity, and that all coupon principles will be made schedule. Now this is how you explain this yield to maturity. Imagine that you buy a bond today, and it has a maturity period of 5 years. If you buy the bond at the market price today and keep that bond up to 5 years, and you receive all the coupon payments up to 5 years, and at the end of the 5 years again you are going to receive the face value of the bond also. If that is the case, what would be your average return per year? That is actually the yield to maturity. So how you are going to calculate is actually very easy. Now you know that our particular formula here, let me bring that formula down here so you can understand. From the previous session, I am going to copy this formula and bring it to here, right? Bring it to here, right? Now you can see, this was the formula that we used to calculate the value of the bond, right? This is the formula that we used, this one, right? Now this is the formula that I have introduced for you to calculate the yield to maturity. It's the same thing if you look at carefully. Now here we have C1 divided by 1 plus YTM to power 1, C2 divided by 1 plus YTM to power 2, then going up to Cn divided by 1 plus Ym to power 2, YTM to power n plus m divided by YTM to power n. Now it is the same thing, isn't it? Now if you look at here, what I have changed only here is actually YTM. Instead of R, I have introduced YTM. Instead of R, I have introduced YTM. So it is very easy to understand what we are going to do here. What we are going to do here is actually we are going to equal this P0 to market value. We are going to substitute this P0 with the market price of the bond. With the market price of the bond. Then other things, C1 we actually know, C2 we know, and up to Cn we know, M obviously we know, number of years also we know. Now by using what we are going to do is we are going to find out R. What is the value for R? Now what we did here is we estimate the R and calculate the P0. Earlier that's what we did. We estimated the R based on the investor's assessment of the risk, and we calculate the P0. Now what we are going to do here when it comes to yield to maturity is we are not going to estimate any R, but what we are going to do is we are going to we think that market value represent the exact value of the bond. So by thinking that, what we are going to do is we are going to put market price here, and then we are going to find out R value that will give us the market price. So that R value we normally call YTM. So that is actually in other words, it is exactly equal to the IRR, internal rate of return, right? So let me move into this particular sum so you can understand. So this is the formula you can use, but the problem here is actually we can use Excel to find this out. We have three ways to find this YTM. We can either use Excel, or we can either use trial and method, or we can use estimation formula. So let me move into the first one, that is we will have to use this uh, trial and error method, right? So let me give you this example. Just look at this example. It says that suppose your bond is selling at 950 in the market now and has a coupon rate of 7%. It matures in 4 years and the par value is 1000. What is the YTM? So that is the question we have. Suppose your bond is selling at 950 in the market and has coupon rate of 7% and maturity period is 4 years and the par value is 1000 rupees. The question is, what is the YTM? Right. Now the first we have to assume an YT. Now according to this trial and error method, what we are going to do is we are going to use our same old formula, and we are going to assume two rates, two required rate of returns and calculate the P zeros or maybe the values of that bond based on those two required rate of returns. And using this trial and method, what we are going to do is we are going to calculate the or we are going to estimate the exact value that is corresponding to the market value. Exact value in the sense exact required rate of return that is corresponding to the market value. You will understand this process when we are dealing with this sum. So first what I am going to do is I am going to assume 10% as the required rate of return. So you can assume any rate you want, but just for easiness of this particular exercise, I am going to assume 10% as the required rate of return, right? So when I'm actually assuming 10%, what I am going to do is I am going to calculate the price of this particular bond, assuming that required rate of return is equal to 10%. So let me go straight away go into the table, and we know the formula. This is the formula that I am going to apply. So going into the second table, present value, interest factor, annuity. So I am going to find out the value that is corresponding to the 10% and 4 years, because according to the sum it says that there are 4 years, and I have identified that required rate of return would be assumed that required rate of return would be 10%. So I am going into the PVIFA table, and required rate of return is 10% and number of years 4 years. So I am getting 3.1699. So that is the first part. So here equal. So let me put that here so you could understand. PVIFA value is equal to 3.1699, and PVIF value that is, we have to go to the next about table. So 10%, 4 years, that is 0.6830. So I'm going to put it here 0.6830, right? So same way I'm going to calculate the value here, multiply. So not here, sorry, not here, it should be here. So I'm going to calculate the value here. C is the coupon value. Now you know the coupon value, the value of the bond. The face value is 1000 and coupon rate is equal to 7%. That means 1000 into 7% is 70 rupees. Multiply by this present value interest factor annuity value, it is equal to 3.1699, and multiply it by 1000 into 0.683, right? So you get this answer. Sorry, here it should be a positive value, not a multiplication. So you get this answer, 904 rupees. 904 rupees. So this is the value of the bond if the required rate of return is equal to 10%. Then what I am going to do is, now it says that the calculated value is 904 and the market price is 950. Now our target market price according to the sum is 950, not 904. That means the 10% value is not going to work. 10% value is not going to work. Then I am going to assume another value. How I am going to assume another value is interesting. Now, if you look at this, the relationship here. Now here the value that I calculated is 904, but target value is 950. Now, if I want to go up to 950, what should I do? Should I increase the 10% value up beyond 10%, or should I decrease it? Now I want to decrease it. Yes. When I am decreasing the value, the price is increasing, because we obviously know the relationship between required rate of return and the price is inverse. So if I want to increase the price, I sure need to decrease the required rate of return. So because of that, I am going to assume 8% here. 8%, not 10%, 8%. So assuming 8%, again, I am going to calculate the present value here. So again, I am going to go to the chart. I'm going to go to the chart and understand the 8% PVIF value, 4 years, 8%, 4 years. So you get 0.735, 0.735. So I'm going to put 0.735. So sorry, 0.735 as the required PVIF. And for the PVIFA, again, I'm going to go to 8%, 4 years. So you get 3.3121. 3.3121. I'm going to put here 3.3121. So again, I'm going to calculate the value. We have 70 as the coupon rate and 3.3121 plus, again we have 1000 rupees as the M, that means face value multiplied by 0.735. So this is the calculation. So you get this value 966.84. Right, now with these calculations, these values, we can approximate a value for this required rate of return. How we are going to do this? We are going to compare these values. Now we know when the required rate of trust, we assume a rate of 10% here, right? We assume a rate of 10%, right? And then we assume a rate of 8%, right? We assume a rate of 8%. So when it is 10%, what was the coupon bond price? It was this 904. When it was 8%, the value of the bond is 966 rupees. So this is how it comes, right? Now the value here, the target value is actually equal to 950. That is what we need to find. We need to find out this value. What is the value? What is the value of the YTM when the price is equal to 950? So this is kind of a this process is known as trial and error method. So we first trial at 10% and then again trial at 8%. Then using these two, we are going to kind of approximate a value as the YTM here. Approximate the value. So what I am going to do here is, actually you can easily understand this. Now I am going to go from 8%. You can start this calculation from either way. You can start it from 10 or you can start from 8. But I am going to start from 8 because I know that I need a YTM value higher than 8 to go down to this 950 from 966. So I am going to start with 8 equal 8, right? Equal 8. Then plus. So then what I am going to do is I am going to get the difference here, the total difference. The total difference. How we are going to get the total difference, right? How we are get the total difference? The interest rate difference is here 10 minus 8. So you have 2% difference. 2% difference. Then I am going to divide it by the difference here in the bond price. So I'm going to get that difference here from this minus this. That means 966.847 minus 904.893. So that is the value. So for this particular part, if you look at this will give you the value of uh, YTM for a 1 rupee of bond price. So the difference here is rupees, difference here is the percentage. So you get the value that is exactly corresponding to the YTM for a 1 rupee. So that's what you get here. Then I'm going to multiply this value with again the difference from 8 to 950. The difference from 8 to 950. That means you are getting rupee value from 8 to 950. 8%, when it is 8% to 950. Now when it is 8%, it was 666. So what I am going to do is again 966 minus 950. Right? So then these two parts give you the value that you should increase from 8% to 950. 8% to 950. So when you hit enter, you get this value 8.54. That means your target, if you want to achieve 950 as your required rate of return, your YTM value or required rate of return should be 8.45, 8.54. So that is your yield to maturity value. Now you can verify this if you want to if you want. All you have to do is again you have to calculate this. It is quite easy for us to calculate. If you want, you can use that PV formula also. PV formula also. Now, if I'm going to use that equal PV, now our required rate of return should be exactly equal to 0.084. So 54. That is our rate. Here, maturity period is equal to 4. Payment. Required rate of now here the payment, how you calculate the payment, according to the sum, it says the payment is equal to, now here 7%, that means payment is equal to 70, right? Payment is equal to 70, and future value, it is always, we have assumed that it is 1000 rupees because face value is 1000 rupees and the type is equal to 0. Now if you do this sum, you should get 950 as your answer. Yeah, now you can see 949.60. Now if you just round it out, so you get this 950 as your answer. See, so when the required rate of return is equal to 8.454, your market value, your price of the particular bond is equal to the 950. That means 950 is actually exactly what you are getting from the market value of the particular bond. So this is YTM of that particular bond. So that's how you calculate the YTM using this trial and error method. But in your particular book, we have given you a separate formula where you can easily find it out. You can use that formula if you want. You can use this formula if you want. So let me give you an understanding about this formula also, right? So I is equal to the amount of interest you are getting, right? So it is 70%. sorry, 70 rupees, 7%, 70 rupees, 7% into 1000, 70 rupees plus, and then M means actually, you know, value for the M, that is that is maturity value, or the face value of the bond, that is 1000 rupees, minus market price. Market price is equal to 950 according to the sum, 950, and we are going to divide it by number of period that we know, that is 4 years according to the sum. So I am going to introduce another bracket here, right? So that is 4 years. So altogether we have the first part. Then I am going to divide it by, again we have market price M 1000 plus, sorry, the M value, that is the future value, or the face value 1000 plus market price is equal to 950, and divide it by 2. So let me put equal mark here. So this is how you get your answer. 70 plus maturity value, face value minus market price, that is 1000 minus 950, divide by number of years n 4, then divide that total value by 1000 plus 950, that is M plus market price, divide by 2. So if you enter, you get an answer around it. It is just approximation, so you get around 8.46. So here you get 8.54, something like that. It is anyway around 8.5. Now if you round this down, up to the next digits, it is 8.5. If you round this down, it is also 8.5. So you get YTM exactly equal to the YTM that we calculated using trial and method by using this particular formula. Anything that I should explain? Yeah, you can use 10%. It is okay. If you want to use, you can use the 10%. I am just using these things to do the calculation. If you are going to use 10%, 10% in the sense, you can use either 8%, the value that is equal to the required rate of return. So easily you are getting 1000. If whatever the values you are going to select for these, assume, you get the same answer. For example, if you assume 12% and 9%, again you get the same. If you want to assume around, let's say 15% and 5%, say again you get the same value. But most easiest way for you to calculate this is actually use this formula. Don't try to do this trial and error method in the examination, because it will take time. Just use this formula. It is very easy for you to take. And again, I'm going to teach you a little function where you can use this Excel facility to find out the answer. So that is IRR. To identify IRR, actually you need to, as I mentioned earlier, this is IRR. So to calculate IRR, you need a cash flow. So what I am going to do is, we know that now we have years going from. So from 0 to 4. According to our sum, we have from 0 to 4, because our maturity period is 4 years. So at the beginning of the cash flow, we will have to pay 950. So I am putting it as a negative value. We will have to pay 950 to buy this particular bond from the market, because market price is equal to 950 rupees according to the sum. Then at the end of the first year, I am getting 70 rupees. Second year, I am getting 70 rupees. Third year, I am getting 70 rupees. And the fourth year, I am getting 1070 rupees. Right? This is clear for you now. It should be clear. Now, this is a 4-year bond and annual coupon bond. So coupon rate is 77% and coupon value is 70 rupees. So at the end of the first year, I am getting 70, second year I am getting 70, third year 70, and at the fourth year, 1000 plus 70. So all you have to do is get the function from Excel IRR, get the function from Excel IRR and select the cash flow. So it will automatically generate your YTM value. So that is 8.53. So I have shown you 3 ways of calculating this YTM, but for the examination purposes, you can just use this particular formula. You can use this particular formula, right? So when it comes to the call, yield to call, it is the same thing. Only thing that is going to be differ is actually number of years. That's all. Because now yield to call is yield of a bond if we are to buy and hold the bond until the call date. Now yield to maturity is if you are going to hold the bond until maturity date. Yield to call is actually if you are going to hold this only until the call date if there is such a option available in the bond. So it is just the same thing. Only thing that is going to differ is this n. Now you just take the same example here. Try to take the same example. It is the same thing that I have given here. Suppose you are considering 10-year callable bond. Just think that 10-year callable bond, which is selling at 950 in the market. Now you has a coupon rate of 8%. It can be called in 5 years, 4,050 rupees. And the par value of the bond is 1,000 rupees. What is the called yield to curve? Sorry, yield to curve. So yield to call, the difference between yield to call and the yield to maturity is, now if you look at this particular bond, if you are going to put yield to call, you will have to stick with this 5 years because we only have 5 years to call. If you are going to calculate the yield to maturity, you will have to go with 10 years. You will have to go with 10 years. And another difference is the call proceedings, the calling price. Now if you are looking at the yield to maturity, you will have to go with the maturity value. That means the face value of the bond, that is 1,000 rupees. But if you are looking at the yield to call, you will have to go for the call price, that is this 1,050. Now let me calculate this. There's nothing much here. So all you have to do is calculate the values. Now the interest is actually 10%. No, here it is, coupon rate is 8%. So 8% into 1,000 rupees. 1,000 rupees is actually the face value of the bond, par value of the bond. 1,000 into 8%, that means it is equal to 80. So I am going to put 80, right? So 80, according to the sum, it says 80 plus call price. So call price is equal to 1,050 minus market price. Market price is equal to 950. Then I am going to divide that value by the n. Now just remember here n should be equal to 5 because we are going to calculate the call yield to call. So if you are going to calculate the yield to maturity only, you are getting 10 years here. Since we are going to calculate the yield to call, we are getting 5 years. So that's it. Close the bracket and close the bracket. Then I am going to divide this by 1,050, that is call price, plus market price, that is 950, divide by 2. So that's it. So I'm going to hit enter. So you get the value, it is 10%. So your yield to curve call value is actually YTC yield to call, it is 10%. If you want to calculate yield to maturity, let me give the same calculate yield to maturity of this particular bond also. If you want to calculate yield to maturity, now you have, the only thing is it is 80 rupees, but instead of this CP you are getting M. So not 1050, you are getting 1000. That is 1000 minus 950. Not 5 years, we are getting 10 years. Again here 1000 plus 950 divide by 2. That is the only difference that we will have to make here. So your yield to maturity would be 8.72. 8.72. Yield to call 10%. So that's how you calculate yield to curve and yield to maturity. Right? So these are the things that I want to share with you about this required rate of return. Required rate of return. Right? Do you have another session after this? Anyone? Yes, you have. Right. Because I need something here to explain, because that part is actually relevant for your assignment. Right? So let me take another 5 to 10 minutes time and explain on that. Is it okay if I am taking another 10 to 5 minutes?
Yes, it's okay.
Right. Okay. Now, if I am moving with this, now we have already talked about bond yields, and we talked about calculation of the bond value, and we identified the risk that is associated with the bond, which we call as interest rate risk. And then we explain what will happen to the bond price when the maturity period changing, when the required rate of return is changing. So that's what we kind of discussed today. And moving with that, then I'm going to introduce some interesting concepts about risk of the bond. So these are type of risk that normally a bond holder is going to face when he or she is doing a bond investment. Now, first one, actually, we know about that interest rate risk. We already discussed. So, rise of the interest rate, changes in the price due to the changes in the interest rate. We already discussed. And this part also we already discussed. Long-term bonds have more interest rate risk than short-term bonds. Then we say low coupon bonds rates also have more interest rate than high coupon bonds. That is also true, because when there is a high coupon bond, the tendency of decreasing price is little bit lower. When you have a low coupon bond, it is the difference between required rate of return and the coupon rate is getting higher and higher when the required rate is increasing. Understood? When there is a low coupon bond, the difference between coupon rate and the required rate of return is getting higher and higher when the required rate of return is increasing. When there is a high coupon bond, when there is a high coupon bond, the difference between coupon rate and required rate of return is getting lower, even though when the required rate of return is increasing compared to the low coupon bond. So those two terms you need to know. When there is interest rate risk high when there is a when there are high maturity bonds or long term bonds, and when there are low coupon bonds, right? So the next interest rate next risk that is faced by a bondholder is actually reinvestment risk. That is here reinvestment risk. Now reinvestment risk is something like this. Now we will have to now if you take example like this, if you want to uh, imagine that you have two bonds, 2-year bonds and 20-year bonds, right? If you are going to invest on 2-year bond, and you know exactly after 2 years you are going to receive the interest and the principal value, right? Interest and the principal value. But after 2 years again you will have to invest that money in a separate bond or something else after 2 years. But after 2 years time, you just don't know what will be the interest rate at that time, right? For example, now if you are in the year 1, and you are investing on that bond, and after 2 years you are getting 1,500 rupees from that investment. Then after you are getting that 1,500 rupees, again you will have to invest that value in the market. But at the time you are investing, that means when you are at the year zero, you don't know what would be the interest rate after 2 years. So that is the reinvestment risk. So the argument here is when there are short-term bonds, we will have to face less reinvestment risk, because when high reinvestment risk, sorry, when there are short-term bonds, we will have to face high reinvestment risk, because if you look at that 2-year bond, you will have to reinvest that 2-year that amount from 2-year bond after 2 years. But if you have a 20-year bond, for example, so up to 20 years, then you don't want to reinvest that value. So that is the rationale here. If you have a long-term bond, that means you have less reinvestment risk. But if you have a short-term bond, you have high reinvestment risk. Now this is interesting. Now interest rate risk, it behaves in this, it behaves completely differently. Interest rate risk, higher the maturity, higher the risk. Lower the maturity, lower the risk. But reinvestment risk, higher the maturity, lower the risk. Lower the maturity, higher the risk. It is exactly the opposite of the interest rate risk. Now, how you are going to deal with this type of situation in the market? Now, for example, if you are going to buy a long-term bond, you know that you are going to expose into the interest rate risk. But you can make up your mind that you are going to expose into the less reinvestment risk. But if you are going to short-term bond, again, you can minimize your interest rate risk, but you are exposing yourself to the reinvestment risk. So how do you manage this in the market? So whatever the bond you are going to buy, if you are going to buy a long term, that means you are going to expose yourself to interest rate. If you are going to buy a short term, that means you are going to expose yourself to the reinvestment risk. So what is the strategy that we can follow here? Any answers? Anyone? No answers. Right. What we can do here is we can actually create a portfolio using these two securities. What we can do is we are going to take two securities, one short term, one long term, and combining those two, we can create a portfolio. By that way, we can reduce some of the risk, because now if you are going to invest like that, the risk of the reinvestment risk will be set off by the interest rate risk, and the interest rate risk will be set off by the reinvestment risk. Likewise, we can create a portfolio of long-term and short-term bonds. That way, we can kind of mitigate these interest rate risk and reinvestment risk. Okay, now moving into the third one, that is credit risk or the default risk. Now, default risk is actually very easy concept to understand. That is the possibility of the borrower will unable to meet the interest and the principal repayment of the obligation of the bond or loan agreement, whatever. Right? So that means once the bond is issued, now we purchase the bond from the issuer with the intention that he will pay us the promised interest rate according to the agreement and the principal amount. That means the face value at the end of the period. So the default risk is actually if something happens to the company, if the company is bankrupted, or if the company is not in a position to pay the interest and the principal right now, financial position, if the financial position is big, so if something like that happen, we have a default risk. That's why we normally say when it comes to the treasury bills and treasury bonds, when the government gives us the promise, we don't have default risk. So because we have the impression that the government is not going to be bankrupt. Government is not going to be bankrupt. Therefore, when the government makes a promise to pay the interest payments and the principals, it will be received in the future. But it is not the case when it comes to the private companies. Sometimes we will have to liquidate private companies. We will have to close down them. Sometimes they go bankrupt. So what we don't know what will happen in the future, right? So that is associated with the credit risk or the default risk, right? But as a layman investor, or maybe the person who is investing in the bond market, we don't have any ways and means of identify this default risk. For that purpose, we actually have separate third-party organizations where they are ranking these private companies based on their credit worthiness. So that ranking we call credit rating. Credit rating. Now, if you look at this particular chart that I have given in this, you can see, if you look at this, now this is a credit rating that I have taken from the, if I say it might be from the Fitch rating. Now in Sri Lanka, we have two third-party organizations that are operating, that is Fitch rating and REM rating. Now if you look at these ratings, when you have AAA, that is the highest safe for money, timely payments of the financial obligation. So if there is a company with AAAs, that means it is the best one to invest, because we have less default risk here. We have less default risk. If it is AA, high safety. If it is A, it is adequate. If it is B, moderate. Double B, inadequate. B, high risk. C, very high. D, currently in default. So that means if you have anything below double B in the sense it is inadequate. B, high risk. C, very high. D, it is currently default. You don't want to look at even. So if it is less than BBB, that means it is an inadequate. There is a high risk involved in high default risk. If there is double B, A, double A, AAA, that means those companies are credit worthy companies. You can invest on those companies expecting that it will pay your interest payment and the principal as they promised. Now, I think you all have seen these values. If you look at the banks, they are always advertising these values. AAA, BBB, they have this and they have that. The BOC have AAA, double A. Likewise, they are advertising on it, right? You all have seen that on television, right? So that particular ranking system gives the investor a feeling of credit worthiness of that company. If that company has AAA rating, that means that company has the highest credit worthiness. So if someone is going to invest such company, they will not face that much of default risk. So then we have inflation risk that we all know. So when the country's inflation is increasing, there is a risk of reducing our real investment rate, real interest rate. So that is inflation risk, right? So when inflation is when we have increasing inflation, right? When we have increasing inflation, that means our real interest rate is going to be deteriorated in the future, value of the interest rate. So that is inflation risk, right? Then I'm going to move into next type of risks. So now we all discuss about these risks: interest rate risk, reinvestment risk, credit risk, inflation risk. Now I am going to explain how you calculate this required rate of return using these type of risks. Now if you look at here, the required rate of return is a minimum return of an investor will accept for owner owing a company's bond. A compensation for a given level of risk is associated with holding the bond. On the other hand, the required rate of return on the bond is interest rate that a bond issuer or must offer in order to get the investor's interest. So required rate of return is equal to what is expected from the investor. Now, how investor is going to expect this value is given in this particular formula. If you look at this, please try to understand this, because this has something to do with your assignment also. So this particular formula is, you can understand how you are going to calculate your required rate of return. So your required rate of return is equal to risk-free rate plus inflation premium plus default risk premium plus liquidity risk premium plus maturity risk premium. If there are some other risks, you can take those things also, right? Okay, now if you are looking at this, you can see real risk-free rate is the, normally in a country we can get the real risk-free rate from the 3-month treasury bill, because when it comes to 3-month treasury bill, we don't have that much of inflation premium because it is only 3 months now. We don't have default risk anyway. Liquidity premium, we don't have a liquidity premium for that because it is government, always we can sell it, because and we don't have maturity risk premium also since it is 3 months. So normally how you approximate risk-free rate in a country, we can get the 3-month treasury bill rate for that, right? 3-month treasury bill rate. And then what an investor do is, based on his assessment of this inflation or default risk, or maybe default risk, or maybe the liquidity risk, or maybe the maturity risk. So based on these things, right, based on these things, we can understand the level of required rate of return. So as an investor, if we have this real risk-free rate, we can get it from the treasury bill, 3 months treasury bill. Then inflation premium, we know the inflation rate of the country. Based on that, we can calculate a premium. And default risk, we can, for the default risk also, we can calculate a premium because we know the exact rating of that particular company. As previously, according to the previous example, you can see now according to this rating, if you know the ratings for this particular particular company that you are going to uh, invest, based on the rating that is given by these agencies, rating agencies, if that particular company has AAA rating, that means your default risk premium would be less. That means you don't have that much of a default risk. If it is double B, that means there is, because that is inadequate here. If it is double B, that means it is inadequate here. So that means there is a high risk involving that. So if there is higher rating, default risk premium will be low. If there is a lower rating, default risk premium will be high. That means you are requesting higher return, because higher the risk, higher the return. That is the bottom line. No? So when you have higher default risk, you will request high return. When you have lower default risk, you will request low return. Liquidity premium is actually how liquid this particular bond in the market. That is also depend on the market as well as the bonds companies reputation, the companies, whether it is a established company or not, or something like that. If the market, if we can sell this particular bond in the market without incurring that much of a cost quickly, that means that particular bond has a good liquidity. So then if that particular bond has high liquidity, that means our liquidity risk is low. That means we will not request that much of liquidity premium. So higher the liquidity risk, we will request higher return. Lower the liquidity risk, we will request lower return. And maturity period is also same. Now we discussed about that. When we have higher maturity, there is a tendency that we get high interest rate risk. So when there is a higher maturity bond, that means we have tendency for go for high interest rates. We are requesting high return for high maturity bonds, and we are requesting low returns for low maturity bonds. So likewise, we can kind of have assessment based on these factors about how much we are going to take as the required rate of return. I think you all understand this. Now, if we have risk-free rate, inflation premium, default risk premium, and liquidity premium, and maturity risk premium. That means you can calculate a value for required rate of return for different type of bond. So when it comes to different types of bonds, required rate of return is going to change based on these characteristics. Now, risk-free return, actually this is always same for each and every bond. Inflation premium, it is always same for each and every bond. So these two parts, it is going to be equal for each and every. Normally we say when you have these two, risk-free rate, real risk-free rate plus inflation premium, that means those two are equal to nominal rate. Real risk-free rate plus inflation premium is equal to nominal rate. Nominal rate is what is given in the bond. Normally what we say like that, right? So those two are actually going to be same for each and every bond in the market. But default risk premium, liquidity premium, market risk premium, and other premiums are going to be changed by bond to bond, by company to company. That is going to be depend on the establishment or maybe the financial position, market position, maturity, and creditworthiness of the company, credit rating of the company. So based on those factors, the required rate of return will be changed. But these two, real risk-free rate and inflation premium, that is applicable for any bond that is being traded in one country. If it is Sri Lanka, so required real risk-free rate and inflation premium is applicable for each and every bond in Sri Lanka. But default risk and the liquidity premium, maturity risk premium will be changed from bond to bond. So that's how you have kind of a understanding about the required rate of return of a particular security of a particular bond, right?